Welcome, everyone. Benjamin Franklin once said, "Nothing is certain in life except death and taxes." And honestly, that is the most accurate quote in history. Taxes are that one thing in life that is more certain than your morning coffee burning your tongue. There is no opting out. Whether you like it or not, if you earn money in Malaysia, you're automatically part of the club. So, put down the panic, and let's figure out how to keep more of that hard-earned cash in your pocket today. All right, why should you actually care about taxes? Let's break it down. Number 1, nobody, and I mean nobody, wants a surprise visit from the taxman. That's not a friendly catch-up, that's a pop quiz with penalties. So stay out of trouble and save your cash for actual bail, not tax fines. Number 2, we want to help you keep more of your money. Let's face it, you worked hard for it. Why let it slip away when you don't have to? Number 3, you'll look like a genius at work. Imagine casually dropping tax-savvy tips in the break room. Your boss will think you're a financial whiz, and your colleagues will be calling you the office wizard. Understanding taxes isn't just about paying, it's about playing the game. And if you know the rules, you win. Simple as that. Taxes come in 2 flavors. Direct tax. This hurts right out of your paycheck, like personal income tax, stamp duty, real property gain tax. Indirect tax. This hurts when you buy nice things. Sales and service tax. Import duties. Basically, direct is for earning. Indirect is for spending. Take a look at the screen. We have 2 heavy hitters in Malaysia. The Inland Revenue Board, IRB. The big boss. The Royal Customs Department, RMDC. The gatekeepers. Here are your 2 questions. Which type of tax does the IRB collect? And which type of tax does the Customs Department collect? I'll give you a hint. One of them takes a slice right out of your salary before you even see it. The other one hits you when you're out shopping for that new iPhone or buying a fancy imported car. So, who takes what? Drop your answers in the comments right now. The self-assessment system. It's exactly what it sounds like. You do your own math first. The government double-checks it later. You have to make sure your math is right, because months later, the taxman is going to pull out his red pen and check your answers. If you got it right, great, nothing happens. If you got it wrong and underpaid, you'll have to pay the difference, plus extra penalties. So, the golden rule is, be honest, do your sums carefully, and keep your receipts, because in this system, you are the boss of your own tax return. Just remember, the taxman will eventually double-check your homework. All right, this is one of the important slides on the screen, because if you miss these dates, you're going to pay extra money, and nobody wants that. Let's make this super simple. There are only 3 groups here. Find which one is you. Group 1. Are you a company? Use Form C. You have to submit it within 7 months after your company's financial year ends. But if you use e-filing, you get an extra 30 days. Easy. Group 2. Are you a normal employee? If you just get a salary and don't run your own side business, you use Form B. Your deadline is the 30th of April. Don't procrastinate. And if you use e-filing, you get an extra 15 days to do it. Group 3. Are you a business owner? If you have your own business or any extra freelance income, you use Form B. Your deadline is the 30th of June. Again, if you e-file, you get an extra 15 days. 2 golden rules to remember if you want to stay on the taxman's good side. Rule 1. Keep your receipts for 7 years. Yes, 7 years. I know your shopping bags are overflowing, but don't throw those away. If the taxman asks to see proof of your claims years later, you need to have them ready. Rule 2. Moving house? Tell the IRB within 3 months. If you move to a new house, you must notify the IRB in writing within 3 months. Why? Because if they send a letter to your old house and you don't get it, they won't care. They'll just say, you didn't reply, and hit you with a penalty. So remember, keep receipts, update your address, and you're safe.
Under Malaysian law, you are considered a tax resident if you meet any one of these 4 conditions. First, the simplest one. You're in Malaysia for at least 182 days in a calendar year. Second, even if you're here for less than 182 days, you can still be a resident if that short period is linked to a block of 182 or more consecutive days in the year before or after. And here's a helpful detail. Temporary absences, like business trips, medical treatment, or short social visits under 14 days, still count as part of those consecutive days. Third, the 90-day rule. If you're here for at least 90 days this year, and in at least 3 of the previous 4 years you either stayed 90 days or more or were already a resident, then you qualify. Fourth, if you've been a resident for the past 3 years and will continue to be one next year, you remain a resident. You only need to satisfy one of these tests to be classified as a resident. Now let's look at the tax rates for residents in 2026. As you can see, Malaysia uses a progressive tax system. The more you earn, the higher the rate, but only on the portion that falls into each bracket. For example, the first RM5,000 is taxed at 0%, the next RM15,000 is taxed at just 1%, and it gradually increases up to 30% for income exceeding RM2 million. The tax column shows the cumulative tax owed up to that tier. So for someone earning RM100,000, the total tax is RM9,400, not 19% on the whole amount. This progressive structure is designed to be fairer, with lower earners paying proportionally less. There are 3 specific groups that enjoy a flat 15% tax rate, which can be very attractive compared to the progressive rates, especially for high-income earners. First, the Forest City Special Financial Zone, or FCSFZ. This is part of Malaysia's effort to attract investment and financial activities into that special zone. Second, the Returning Expert Program. This is designed to bring back Malaysian professionals who have been working abroad, offering them a competitive tax rate to encourage them to return and contribute locally. Third, non-citizens holding key positions or C-suite roles, like CEOs, CFOs, or CTOs in Malaysian companies. They also qualify for this flat 15% rate. If you or your employees fall into any of these categories, it's worth exploring because the flat rate can result in significant tax savings. Now let's shift to non-residents. If someone does not meet any of the 4 residency tests, they are generally subject to withholding tax on Malaysian-sourced income. The rates vary by type of income. Here are the key ones. Public entertainers, 15% on their professional income. Interest, 15%. Royalties, 10%. Rental of movable properties, 10%. Advice, assistance, or services rendered in Malaysia. This falls under a special class and is also taxed at 10%. Dividends from resident companies, up to RM100000 is exempt, but we'll cover the excess in a moment. Business and employment income, discounts, rents, premiums, pensions, annuities, and other gains. This broad category is taxed at 30%. This includes payments for part-time or occasional broadcasting, lecturing, and writing. Other income not specifically listed, 10%. And foreign film actors and movie crews filming in Malaysia enjoy a concessional rate of 0% to 10%, depending on the specific arrangement. If you're paying a non-resident for services or income sourced in Malaysia, you may need to withhold tax at these rates and remit it to the Inland Revenue Board. Next, let's talk about dividends. Under the single-tier system, dividends from resident companies are generally tax-exempt in the hands of shareholders, but only up to RM100000. This applies to resident individual shareholders, non-resident individual shareholders, and individuals who hold shares through nominees. The tax is imposed on the excess amount after eligible tax deductions have been applied. So, for example, if you receive RM150000 in dividends, the first RM100000 is exempt, and the remaining RM50000 is taxed at 2%. That's RM1000 in tax. This is relatively low compared to other income tax rates, but it's still important to account for. This part is about personal relief. You may pause and refer if you need to. These are reliefs just for you and your partner. Everyone gets a standard relief of RM9,000 just for being a taxpayer. Spouse, if you have a husband or wife who doesn't work or has very low income, you can claim RM4,000. Disability, if you or your spouse have a disability, there is extra help, an additional RM7,000 for yourself or RM6,000 for your spouse. If you have children, you can claim reliefs for each of them, but the amount changes based on their age and education. Young children. For children below 18 years old, you get RM2,000 per child. Older students, if they are over 18 but studying full-time, like in A-levels or matriculation, you still get RM2,000. University students, if they are in a higher education institution, like a diploma in Malaysia or a degree overseas, the relief goes up significantly to RM8,000. Disabled children, if your child has a disability, you get a much larger relief of RM8,000, and if that disabled child is also pursuing higher education, the relief doubles to a maximum of RM16,000. Life insurance and takaful, you can claim up to RM3,000 for life insurance policies or family takaful. EPF Employees Provident Fund, Whether you are a normal employee or a civil servant, your EPF contributions, voluntary or compulsory, give you a relief of up to Rm 4,000. Private retirement. If you put money into a private retirement scheme, you can claim up to Rm 3,000. This is valid until 2030. Medical education insurance. Premiums for medical or education insurance for you, your spouse, or your kids are claimable up to Rm 4,000. SOCSO. Finally, your monthly SOCSO contributions give you a small relief of Rm 315 for parents-grandparents. You can claim up to Rm 8,000 for their medical treatment, dental work and checkups. This also covers vaccinations for them up to Rm 1,000. For yourself, spouse or child, there is a much higher limit of Rm 10,000. This covers serious diseases, fertility treatments, dental work, and even mental health consultations. Important for young parents. If you have a child under 18 with a learning disability, the costs for diagnosis and rehabilitation are also covered under this Rm 10,000 limit. This slide is about investing in your own skills and helping family members with disabilities. Course fees. If you take courses to upgrade your skills, whether it's a degree, a diploma, or a technical course, you can claim up to Rm 7,000. Note, there is a specific limit of Rm 2,000 for upskilling courses recognized by the government, valid until 2026. Supporting equipment. If you purchase equipment like wheelchairs or special aids, for a disabled spouse, child, or parent, you can claim up to Rm 6,000. Lifestyle. For you, your spouse, or your child, you can claim up to Rm 2,500 on things that help you learn: books, magazines, computers, smartphones, tablets, and your monthly internet bill. Sports. For you, your spouse, child, or parents, you can claim up to Rm 1,000 for buying sports equipment, gym memberships, or paying sports competition fees. Breastfeeding equipment. You can claim up to Rm 1,000 for buying breastfeeding equipment. Note, you can only claim this once every 2 tax years. Childcare fees. You can claim up to Rm 3,000 for fees paid to childcare centres and kindergartens. A new update for Budget 2026 expands this to include care centres for children up to 12 years old. National Education Savings (SSPN). If you deposit money into the SSPN account for your child's future education, you can claim up to Rm 8,000. Either parent can claim this, and it is available until 2027. Finally, we have reliefs related to your home and leisure activities. Green items. You can get up to Rm 2,500 for costs related to EV electric vehicle, charging stations, composting machines, and starting in Budget 2026, home food waste grinders and CCTV cameras. Valid until 2027. New home loan interest. If you bought a new house between Jan 2025 and Dec 2027, you can claim the interest you paid on your loan for the first 3 years. You get Rm 7,000 for a house under Rm 500,000 and Rm 5,000 for a house between Rm 500k and Rm 750k. Tourism. This is a new and special one. Only for Year of Assessment 2026, you can claim Rm 1,000 for entrance fees to tourist attractions, arts and cultural programs, so keep those travel and theme park receipts. The reliefs lower your taxable income, rebates directly reduce the actual tax you owe. Let's dive into it. First, the individual rebate. If your total chargeable income is Rm 35,000 or below, you are entitled to a rebate of Rm 400. If you are married and you and your spouse are assessed separately, both of you can claim this Rm 400 rebate if your individual incomes are below Rm 35,000 each. However, if you and your spouse choose to file jointly, joint assessment, and your combined chargeable income does not exceed Rm 35,000, you can claim a combined rebate of Rm 800. Second, religious dues. For our Muslim taxpayers, you can claim a rebate for zakat, fitra, or other Islamic religious dues paid. This is a straightforward rebate equivalent to the actual amount you expended. Third, and this is a special one, there is a rebate for the departure levy paid for performing Umrah and pilgrimage to holy places. Please note the specific condition here. This is claimable for the actual amount expended, but strictly limited to 2 trips in a lifetime.
In our next episode, we are actually going to walk you through the math. We'll show you exactly how to calculate your final tax payable using all these reliefs you've just learned about. You won't have to click "I don't know" anymore. So, if you want to become a tax-savvy master and stop scratching your head every April, please hit that big red subscribe button right there. Give us a like if this helped you today, and share this video with a friend who is always confused about their taxes. Thanks for learning with us, and we'll see you in the next episode. Stay tuned.